Fall is here and winter is coming, and you need to shop Lowe's Customs. For the ladies, there's stunning designs and colors. For the men, Lowe can make something manly to keep your insecurities in check. But wait, there's more. For you simps, there's a special Simp Edition, where Lowe will roll around in it, blow smoke from the finest Southern Eastern American marijuana. She'll even rub her pretty feet all over it just for you. So what are you waiting for? Shop Lowe's Customs now, exclusively on the John Galt Urban Landlord channel. Let Lowe help you stay cozy and warm this season. Shop Lowe's Customs today.
GETCRACK. Wake up, motherfucker.
Yo, what's up, guys? Wake up. It's fucking 4 a.m. about Eastern. It's 1 a.m. my time. So let's see how the Chinese markets are doing. That's the only exciting market that we have so far. All right, let's see. Yeah, so it opened with 2 red candles on the hourly, but it recovered some of that. So inconclusive. I still haven't decided if I want to short the Hang Seng right now using Yang. So the ETF I would use, because I'm a lazy guy. I'm not using options. I'm not using margins to short the ETFs or any company shares. I'm going to use Yang. So Yang yesterday closed below $3. It's down 21.7%. Let's see. I think today it will recover a little bit. I think pre-market it will be up about 6% or so. Let's see. Yeah, pre-market looks like it's about going to be up 3%, 6%. Yeah, that's right. 7%, not bad. So we'll see. We'll see if I'll buy it. So we'll be back up at around $3 by the time market opens. Perhaps, or you never know if some other news will come out. But today should be another quieter day until 10 a.m. our time. 10 a.m. our time, we'll have the ISM service PMI. So that should give you some juice during the day, but I don't expect anything in the U.S. market still until tomorrow. Tomorrow around 8:30 when the employment data for September is released, and that will give us some new fresh data for the market to digest. Okay, let's see that. I'll do that. Yeah, let's do this. I'll share this screen. And remember, guys, to do your homework. You should have been reading. I put the link in the chat. If you guys didn't do it, that was your homework I gave you from last week. Anatomy of a Trading Range, the PDF. So that's your homework. There's the link. I put it back on screen. Let me zoom in on the calendar here. So today, so 7 a.m. my time. I'm gonna change it to Eastern for you guys. Okay, so Eastern, 10 a.m. Eastern, ISM service PMI data. That'll be what we're looking for. Yesterday, we had some oil data. So if you remember, I bought some oil ETF. I bought oil U It was up 4% in the morning, but then when the data came out for the oil, we see a lot of buildup in oil barrels. So that was bearish, and it came back down. So nothing much today. Oil, you kind of recovered, but yeah, it was up over close to 4% in the morning. Dipped down on that report, came back up. So I mean, we'll see. I'm still holding it. So if you're holding stocks like Chevron, yeah, you see that same pattern here. Yeah, I think it looks pretty bullish. I think I'll hold for now. So unless Friday's report shows pretty bad employment, then yeah, all this stuff will just crash back down to the lows again, and we'll start right back where we were last week, Thursday, and we'll have to start all over. So yeah, everything's all data dependent, every piece of data. As far as the striking goes, I don't know. Haven't heard any updates on that. I think they're still on strike. I'll read some articles about how shipping is working. Let's see how shipping is. Here, I'll start off with some pessimistic viewpoint. You guys might not like this. Some of you might. I don't know. You guys have some bias. Here, this is an article written September 19th, 2024. So close to about two weeks ago. Trucking data shows a recession. So you see this plot here, Cass Infosystems Truckload Line Haul Index. And the blue line, you have manufacturing employment. Okay. The folks at Cass Information Systems spend their time gathering a lot of data about how much money gets spent on shipping things. And their data show that the US is already in a recession of economic activity. This week's chart features a fun comparison I put together, comparing the Cass Truckload Line Haul Index to data from the Bureau of Labor Statistics on total U.S. manufacturing employment. So, from the Cass's website, Cass Truckload Line Haul Index is a measure of market fluctuations in per mile truckload line haul rates, independent of cost components such as fuel and accessorials. Interesting word. Never heard that one. Let me zoom in. Make sure you read it. Take away the banner here. Got it. Okay, so it's much easier for you to read if you're reading this. It peaked at 168.6 back in May 2022. That was when container ships were parked off of Long Beach, California, because they could not unload fast enough, in part because of a lack of trucks. Americans were buying stuff like crazy, spending a lot of COVID money that Congress was throwing at the problem, abetted by the Fed cutting interest rates to nothing. Now that the index is down to 136.7 and has recently started dropping faster again after leveling off earlier in 2024, that drop makes things tough for truckers who bought their own rigs back in 2022 and now are struggling to get enough work to make the payments on them. This drop in shipping rates has not yet flowed through to manufacturing jobs, although those data are curling over and are now at the lowest level since September 2022. The history of the Cass Truckload Line Haul Index data only goes back to 2005, so we cannot see how it would have behaved farther back. But we can see from this limited data that it is not a good sign for manufacturing jobs to have trucking rates falling. Cass also publishes separate indices on total shipments and on expenditures. Both have been showing negative year over year rates of change since February 2023. All right. So you see that. Here, shipments and expenditures, red and green. Those rates of change have become less negative than what they showed at their extreme lows in late 2023, but they are still showing shrinkage versus a year ago. That is another way of saying that this has not been a good time to be in the trucking or shipping businesses. We still have rising rates of GDP in the US right now, as of the latest reported data. But every other time that the Cass Expenditures Index rate of change has gone negative, has brought falling GDP at some point as part of that episode. So it will be exceedingly unusual for the US to escape a generalized economic recession this time, with trucking already in one. So that's interesting. Um, Now, I think I've explained before that we live in an America of two halves at this point, right? One half being manufacturing, the other half being services. We'll get service data today in the morning. We already had manufacturing data 2 days ago. Now, that data shows weakness. So if you're just looking at that half of the United States, yes, we have a weakness in our manufacturing industry, which is here, I'll show you this. See, Tuesday, ISM manufacturing PMI. We got a print of 47.2. What that means is that when the number is below 50, we are in contraction phase. We look at the employment here, the ISM employment, 43.9, very low compared to last month's 47. So, yes, we are in contraction phase. We have been below 50 for most of this time when interest rates have been high. So they're doing a good job killing that side of the economy. Now, what about services? Services will come out today. And we're still above 50. So for the most part, yeah, most of these months we've been going above 50. And for some of the summer of 2024, yeah, we've been below 50. So kind of mixed picture, but in general looks better than manufacturing. Let's see what the employment is. Yeah, we expect to be above 50. Yeah, same thing. You see some weaknesses here, but overall, it's been strong the past 2 months this summer. All right, so let's see what pre-market's doing for the bear ETF Yang is up about 6.67%. So, yeah, I haven't decided yet. Should I be bearish on China right now? But I'll keep you guys updated if I change my mind. All right, remember, do your homework. Read this Anatomy of a Trading Rage. So, today I have a video to show you guys. I'll show some clips of it. It was a presentation done today by Wyckoff Analytics. So, the Wyckoff people that I pretty much try to pass off to you all the methodology, the way they do the teaching, I pretty much replicated and I'm giving it to you for free. These guys will charge you about $1,000 for the class. I think if you're a really serious student, it probably is worth it because when you go to the class, they have tons of homeworks. They have all the students doing little projects. You guys study charts all day. I mean, it's a real big time commitment, and I wouldn't pay that money unless you really want to set aside some time to learn and practice with them. But yeah, it's not cheap, and most of them will take the class again and again because you're not really taking it for the class, you're just taking it for the work, one-on-one work with the teacher, as well as working in class, doing the homeworks. And I think people find a lot of value in that. But here, I'll give you the link. So if you're interested, you can go there. I'm not being paid to advertise their stuff. I'm just telling you what the options are out there. Yeah, there you go. The link. I'll give you the link. So yeah, Wyckoff Analytics. They're very good at teaching. They've been teaching a long time, the Wyckoff method. So I can't highly recommend them enough. I haven't taken it myself. You know, I don't think I need to improve my game to that point because I'm such a lazy trader anyhow. I have tons of money that I don't need to be accurate. But for you guys that are really serious about learning how to trade, I think it's worthwhile. At the very minimum, you can pay about $90 a month, and they'll have weekly, hourly updates of the market. So that's what I'm going to show you guys today. Um, it's one of their packages, and I'll show it to you. So this is like a sample, all right? And I think it'll give you an idea of how they think. So the mindset is so important here. When you understand the mindset, you can really gauge how you can improve yourself when looking at the markets. It's always about how you look and approach things.
I see some green shoots. We need to have some kind of stupid bar. I just think this is a classic structure, Lamont. And I'll show you guys, a little trick here. When you see some of the stuff that we're working on, you're going to like it. Welcome back, Wyckoff Nation, to the Wyckoff Market discussion. Today is October 2nd.
So this is the Wyckoff market discussion. I think they do it about twice a week or so. I mean, twice a month. And yeah, the promotion price is about $80, but usually it's 99 or something like that. So let me skip ahead. I'm gonna show you how they look at the NASDAQ chart. So that's about 8 minutes. 8 minutes timestamp. Here.
There's income, there's growth characteristics, growth, they call it GARP, growth at a reasonable price in these areas, and the institutions will gravitate to that. And this is just an opportunity. And we believe that there's still a case for more life left in the bull market. And we'll talk about that also.
By the way, guys, stick around, because if we have enough time by the end of the program, we're going to be looking at your symbols that you're going to submit in the questions box. And again, if time allows, we'll definitely we'll go and give you our view on how we read the charts of the stocks that you're looking at. All right, Bruce, let's talk about NASDAQ. And this is a long-term chart. This is from 2021. We see here the 2022 correction. We see the 2023, 2024 uptrending environment. Where we are in the structure right now relative to this uptrend, and what do you think is going on here in terms of the Wyckoff structure?
Well, I'm really interested in what you think, Ramon, but I'll just make this point that we started to do this chart back in 21 in the uptrend it's really our note-taking chart. It's the way that, and Ramon may characterize some of these Wyckoff structures slightly differently than me, and so I certainly defer to him on his Wyckoff analysis. But these are characteristics of the way that bull market tops end, bear markets unfold, and then ultimately accumulation structures. And I'm really quite proud of what we've done, Ramon, because you can see all through that 21-22 period that we right here in WMD, talked about, managed the downtrend and then the accumulation structure. And this was back in a period when the much of Wall Street was in deep fear about the markets, and we're looking at these structures from an accumulation characteristic and seeing all kinds of internal divergences in the way that they're acting. And look at this magnificent uptrend. And so the NASDAQ 100 has really been a star. And the thing that I would just point out here, we don't have a lot of time to spend on this, but we talk about it all the time in various ways. But this, look at this August low. That August low to me is very important because it comes after what I consider to be, Ramon, a climactic high at the top of the channel. This is classic Wyckoff channel construction. It goes up and touches the top of that channel, and then the failure that occurs comes on volume with spread. This is what we would characterize as an automatic reaction. And so we automatically draw resistance and support. And we would say that the market is likely to be bounded by those areas, not that it can't slightly get above and below them. But notice what happened back in 22 when we had selling climax, automatic rallies, and so on. We had a range bound condition in an accumulation structure. And so you can see that these become very, very powerful. And here we are. And we're looking at this, and it's too early, I think, to be able to tell. Ramon, I'm sure, has views on this, but whether or not we're looking at the beginning of a distribution structure, or potentially this could be accumulation, reaccumulation of some sort. But the one thing I would point out, Ramon, is I think that break of the stride, which was rather deep before it came back in, and then look at how close we are to the demand trend line underneath at this time. And so that, I think, could be very interesting and could have the effect of taking the NASDAQ 100 out of this uptrend that's been enforced since the end of 22.
Mm-hmm. Yeah, it's just a fascinating case study because of the depth of this reaction, because of how supply is coming in, because of the aggression of this reaction as well. This is better than what we had for NASDAQ in this change of behavior. And it is a change of behavior. This is the largest reaction in the uptrend, suggesting that we're going to change into a new environment, which is the trading range. And for now, as I usually would say, we are in the uptrend until we're not, until we have proven that the structure was broken. What was broken, really? Did we break the previous low? No, we did not. We created a slightly higher low. The next low is a higher low. And even if we have, and for those of you who are thinking we're going to have like some kind of bearish decline, which I think is possible, but I'm still inclined to think that we are going to be kind of like range bound here. You could undercut this low, the latest low, and still recover and still have the structure that would suggest some kind of continuation to the upside. Please note the character with which the price moves to the upside. This is just a pure chart reading that we do here in WMD. And by the way, I just want to mention this again. We're at the weekly episode 422. Do you know how many years we've been on air? We've been on air for quite some time, Bruce, right? So this is what, oh my goodness, the 8th year or so? Yeah, 9th year. So we've been through so many market conditions. We called it here to the downside right here back in May. We said we're going to go into the trading range that is most likely is going to be accumulation. And even though it was pretty difficult at the beginning, we found the ways to characterize this as an accumulation. And then I want to point your attention to this strength that is being followed by this strength. And even this rally, the smallest distant rally that we see in this sequence is still pretty strong. So it's not unusual to see that supply is coming in, especially behind, you know, some of the political events, geopolitical events, economical, fiscal events, and so on and so forth. But look how the price reacts immediately off this low. Again, in the next rally, immediately reacts up. We were bringing different analogs. We've talked about this analog right here. We said, what if this is 1, 2, 3, 1, 2, and 3? Well, this analog right here kind of is broken, right? Because we don't go and we don't create the lower low anymore. If anything, we extend the space in here, we create a higher low, and we immediately have a slightly higher high right here. So again, we could consolidate here, we could create the apex on the back end of the moving average. By the way, look at this institutional buying at the 200 moving average. They're just eating up every offer that they have here. So I would not be surprised if we break temporarily here, consolidate more based on the seasonality into the US election, and then continue to the upside. And maybe the next advance is not going to be as astronomically strong, but I don't see any breaks in the structure, Bruce. What about the breadth, Bruce? We're talking about here what? All of the stocks above 50.
All right, so that gives you a good idea of how they approach things. Now, let me try to replicate it for you guys in my own chart. Okay, they went over through a lot of terminology there a little bit. Maybe it went over your heads. So let's try to clear it up. Here, so this is the NASDAQ 100. All right, this is the chart they used. Now, you see here, I'm using two SMAs. Now, I hid them. This is the 18 SMA. You see that blue line? That's a moving average. It takes 18 of these bars. I'm using weekly candles, all right? Each bar here is weekly, 1 week's worth of data. The blue line is following it. Okay, it takes 18 of them and averages them to create that blue line. Now I'm showing you the orange one, which is a 40. So it takes 40 bars and averages them. It moves slower because it takes more of the data. So for it to turn, you need to have all 40 bars start going down for it to turn. So it takes a longer time for it to move. But in general, what it does show is that there's a trend. Whenever the blue line is in parallel to the orange, we have a nice trend. So even though you see here, since 2023, we made a bottom in 2022, but the completion of that bottom was around Q1 of 2023. You see every red candle here, it doesn't really affect things. The blue line, which is the 18 moving average, and the orange line, the 40 moving average, continues to be parallel. So even this extreme overbought condition, and then we had a sell-off, 3 red weeks. That's pretty significant. 3 weeks of red. And these bars were not small, right? This one was down 4%. This one down 2.5%. This one down 3%. So 3 large red candles before we hit a green one. Even this price action didn't cause anything to change this parallel advance. So there's nothing, you can't say this is a bearish trend. We're still on trend here. Even though it's getting volatile, we're still staying on trend. Now, we're not done with this week. Remember, we are on Jewish New Year's. We are in Rosh Hashanah. We have to sell on Jewish New Year's. So Jewish New Year's was yesterday, sundown, the sunset. And we got about a couple more days to Friday before the end of Rosh Hashanah. So we'll see. We'll see what Friday does. If Friday is a bad employment data and this thing is a red bar, huge red bar here, I'd be pretty worried. I'll be pretty worried for the Monday because you got 2 days where you can't trade, Saturday, Sunday, and the media can make whatever news they want to spin, make everything sound gloomy and doomy just to make Monday drop even further. So it wouldn't surprise me. It would not surprise me. We'll see. We'll see. Get ready. Now, let me explain more about these moving averages. I think it's good to have an overview of things for the beginners. Let me get a Investopedia article. I like using Investopedia. I'll share it. So here we go. What's a moving average, huh, guys? Oh, they got a video. How nice. All right. Moving average. Purpose, uses, formula, and examples. What is a moving average? In finance, a moving average is a stock indicator commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data by creating a constantly updated average price. By calculating the moving average, the impacts of random short-term fluctuations on the price of a stock over a specified time frame are mitigated. So what I used was a simple moving average, okay? Simple moving averages, SMAs, are use a simple arithmetic average of prices over some time span, while exponential moving averages place greater weight on more recent prices than older ones over the time period. So what I showed in that chart previously was a simple moving average. I did not use exponential moving averages, but I think it's good to go over the definition of the exponential moving average because when we do our lesson for today, I'll go over that because I needed to tell you about a secondary indicator. I'm going to keep talking about these secondary indicators. So I think it's good for you guys to learn that. A moving average is a stock indicator commonly used in technical analysis. Yeah, we went over that. Yeah, we already went over that. Understanding a moving average. Moving averages are calculated to identify the trend direction of a stock or to determine its support and resistance levels. It is a trend following or lagging indicator because it is based on past prices. Okay. Now, most indicators are lagging. They're going to use data from the past to generate another data. So that's why, yeah, very, I don't know if I could tell you there's anything truly leading, like an indicator that will tell you in advance what's going to happen from just basic technical analysis. That's why I use a lot of these secondary indicators to try to tell you, okay, there's a crash ahead, right? So that's what the last lectures I did were showing you the secondary indicators using ratios, using the margin data, and I could say like, hey, I can use that to predict something in the future. So I'm using lagging data to try to predict something in the future. Now you could say that's leading or not. I can't really say. I don't think there's really a true leading indicator. That would just basically mean I have a crystal ball. Okay, let's continue on with this article. The longer the period for the moving average, the greater the lag. A 200-day moving average will have a much greater degree of lag than a 20-day moving average because it contains prices for the past 200 days. 50-day and 200-day moving average figures are widely followed by investors and traders and are considered to be important trading signals. Investors may choose different periods of varying lengths to calculate moving averages based on their trading objectives. Shorter moving averages are typically used for short-term trading, while longer-term moving averages are more suited for long-term investors. Okay. Let's look at the formula here. A simple moving average is calculated by taking the arithmetic mean of a given set of values over a specified period. A set of numbers or prices of stocks are added together and then divided by the number of prices in the set. The formula for calculating the simple moving average of a security is as follows. SMA is A1 plus A2 plus blah, 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 AN over N. So that's pretty simple, right? It's just an average. I just take the data set given by those bars and divide it by the number of periods. Now, usually I would believe, unless you change it in your charting tool, you'll just take the closing price of each of these candles or bars and then put them in for A1, A2, all the way to AN and divide it by the period. So if it's like a 4-day moving average, you'll take 4 pieces of data, closing price of each one, and then divide it by the time period 4. Now you could get more sophisticated. Maybe you'll take the average of that bar. Like you'll take the open plus the close divided by 2, put that for A1, and then divide by N. Yeah, you can do that. We can go to TradingView and change all that. So let me go over it for you now. I think that might be interesting for you to see how I do it in TradingView. Because, you know, I take a lot of this stuff for granted, right? So I keep forgetting that a lot of you guys probably never, ever even touched a charting program or anything like that. So let's go here. Let's go to the settings. So let's go to my SMA 18, right? So here, 18 was N. Remember that formula? So N is 18. What's the source? Aha, close. So I just take the closing price of each bar. So here we closed at 17,000. Here we closed at 17.7 thousand. So I only can take one number out of each of these bars, the closing price, and using that for my data set. I can change this. Maybe I'd rather use the low. Maybe I'll use the high. Maybe I'll just use the opening price to do the calculations. Or maybe I'll just do an average. You see this? HL2. That means high plus low divided by 2. So an average. So if I do this, I'm taking an average of an average. So I have 18 bars. Let's say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, blah, 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 18 bars. And now I just do high, low, divide that by 2, and use that number for A1. Then I do high, low, right? High, low, divide that by 2, and I got A2. And I keep doing it. I could get even more sophisticated. Maybe I'll just do the open, the high, the low, the close, add all those numbers up, divided by 4. Okay, change that. So, I mean, there's not much difference. I didn't see a change in this blue line. Very little. So that's why I don't even mess with it. But, you know, you guys can fool around, see if there's anything different yourself, because the charting software, but very little change in this blue line. So I'm just going to stick with the standard closing data here. I mean, let's see if it even changes the 40 SMA. I doubt it. It should change this even less. Barely any change. You see that? You shouldn't see a change at all. I mean, unless the price is so volatile that affects it. It really should not change the thing at all. Now, let me add it. Let me add something then. Let's try to add another SMA and make it smaller. Okay, let's do a 5-day SMA, huh? So let's do that. Let's do that. You see this little purple line here? Let's make it thick. Make it thick for you guys. Okay, you see that? You see that purple line? All right, so let's change it. I'm using closing data. What if I used opening data? Okay. Nothing much. Not much change either. So I don't see anything. How about I do all these averages? Yeah, I see some change. I see some change. Yeah, there's some change. So if I use a shorter moving average, I definitely see more of a pronounced change when I use a different one. High, low, 2. Yeah, a little bit. But essentially not much. Not much. Not much. Not too much still. Now, let's say if I did an hourly chart here. I use an hourly chart. Maybe it will look a lot more pronounced when I change these things. Yeah, a little bit, but not much. I don't think you should see much of an effect. Okay, guys? So that should give you a rough idea of how moving averages work. Yeah, I think it's good to go over that. Now we're going to get more sophisticated. We're going to get more sophisticated. let's do EMAs. Okay, so let's go back to the article. Now we're going to discuss EMAs. Hopefully it doesn't confuse you guys. Exponential moving average. Okay, it gives more weight to recent prices in an attempt to make them more responsive to new information. To calculate the EMA, the simple moving average over a particular period is calculated first. Then calculate the multiplier for weighting the EMA, known as the smoothing factor, which typically follows the formula. 2 divided by selected time period plus 1. Okay, now you guys are probably getting a headache. For the 20-day moving average, the multiplier will be 2 divided by 20 plus 1, 0.0952. The smoothing factor is combined with the previous EMA to arrive at the current value. The EMA thus gives a higher weighting to recent prices, while the SMA assigns an equal weighting to all values. Now, you have to remember, A1, A2, all the way to AN, no difference. They're all computed equally, so this is why it's an arithmetic average. Okay. Now, I don't know if you guys ever heard of something called geometric average. There's other kinds of averages too. Most of the people, they don't know those. They just remember from school. I got a bunch of numbers. I want to find an average. I take all the sum of those numbers and divide by the number of those items, and I get my average. That's what the SMA does. But here, we're adding a weighting factor. So the weighting factor of the value of today is going to be larger than the weighting of the past. That's what the EMA does. Okay, so if you don't understand what I just told you in this article here, and I don't expect you to at the outset, what you need to know is that the data at the present and the near past is weighted higher than the data in the far past. Okay, so the more days we have, see the number of days here, D, number of days. If D is getting bigger, that means this fraction is getting smaller, right? So we're weighting things differently just based on the number of days that things were. All right. And the smoothing factor is something else, blah, blah, blah. I'm not going to get into it right now. I don't think we need to. But I think you can see here in this chart, the EMA, the yellow line, responds to price changes faster than the simple moving average. Now, I think this example is pretty lame. Let me go back to the chart. I think you'll see things visually. It'll make more sense. Okay, so right here, I got two moving averages, the 18 SMA, 40 SMA. So these are just the averages. Let me remove one of them. Let me remove the 18. So this is just a 40-day moving average now. Okay. We can go back to the weekly. You see, remember the weekly, nice, smooth, orange. Here, very smooth. Now let's add an EMA. Let's add an EMA. Okay. Exponential. Let's do this. Okay. Now let's do 40. So I'm making my length 40. Okay. Now I'm going to use an EMA. All right. Wait, that's for smoothing. I don't need that right now. So this is the EMA. So you see a little difference here. Change the blue line. Yeah, let me make it cyan. All right. So you see a little difference. So what this does is it tries to track. So you see this change here in the price? It kind of hugs it, right? It hugs it better than the orange. So that's why the recent prices, when you see this movement up, that's given more weight. So it's trying to ignore more of the past. So it's following it better. It's tracking it better. All right. Now let's go to the daily. Let's go back to daily. So each candle is a daily. You see that? It's hugging it. It's hugging it, hugging it. Here you see the trend is more linear. So you kind of see like it's following a more linear trend here. So that's why both the EMA and SMA don't have much difference. But when you see this, you see this more rapid approach up. The EMA starts deviating more because like you see it moves at a faster clip than this. So this slope was more gradual. Now this slope is getting steeper here. So the EMA is trying hard to try to follow it better. So yeah, that's just the subtle differences between an EMA and an SMA. All right, guys. Hope you can understand what I'm saying there. But in any case, I'm not going to use the EMA. I'm just going to stick with the SMA. But learning about the EMA is important because a lot of other indicators will use EMA instead of SMA. So knowing the difference, is kind of helpful. I know some probably won't dive deep into the mathematics of things, but you should at least know some basics, some groundwork here to make your life easier later on when we discuss things. EMA for shorter trends. Yeah, you could just say it. That's true. But anyhow, yeah, the reason I brought it up because later on when we go to our teaching section, I'll bring up secondary indicators that we'll use in EMA and versus an SMA. So you'll know the difference there, and it'll hopefully make some sense. But we'll talk about it later because if I talk about MACD, I'll definitely have to explain EMA again to you guys. Anyhow, so let's see what else. I think that was a good lesson. Let me go back to the video. Let's go back to the video. I think I'll discuss a little more about this. So before I go back to the video again, he talked about demand line. So the Wyckoff dude was saying demand line. So usually you try to draw a trend, a parallel channel like this. You say there's a demand at the bottom of a channel here and supply at the upper band of the channel. So you see this moves so well. This is very nice. And every time it hits the top of this channel, right, we hit a point where we get overextended, overbought, and then we pull back to the bottom of the channel. But in any case, everything follows a trend. So even with this extreme case here where we went overbought, oversold, we're still in this channel. So right now, I can't say anything's bearish. I cannot say it. Maybe on Friday, this thing will just be deep red. We just crash right through the channel. And it's just, oh, great. The rest of October is down, 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 down. But I can't say that, right? From what I see here, from this current data, I see no problems. That's what it is. But what you did here is that this deep reaction, the steep reaction, steeper than this. And here we had kind of a steep reaction, but it was only one bar. So each of these was a weekly bar. This is very significant. When you see 3 red candles like this, what the Wyckoff guys were saying is that they're assuming that we're entering a trading range. So something so significant like this, you can't resume your uptrend. Most likely, not guarantee, we're going to be in a trading range. Worst case, something bad happens. This is a big red bar and we start going down. So then this will just be a start of a downtrend, right? But, I'm not here to give you a crystal ball. So let's just say for now, this is the most likely case where we just continue on. Continuing this trend is a possibility. Going down is a possibility, but most likely this reaction here suggests that we are in a stage 1 of a new reaccumulation or distribution phase. All right, so let's continue on with the video.
I love these indicators. And so in this case, we have two. These are, as Ramon said, these are stocks above their 50-day moving average. And it's a type of a breadth indicator. So just to, visualize in your mind any stock being above or below its 50-day average as a measure of an intermediate term trend, and defining it as up if it's above or down if it's below. It's very simplistic, but note how the momentum will start to wane. And you can go a long period of time with an uptrend with deteriorating upward momentum. And there's ways to read these charts, but it is helpful because it tells you what the likelihood or the probability of success is in your campaigns, because you either have greater numbers of stocks above their 50-day or fewer. And so that affects probabilities of success. And right now you can see that stocks above their the 100, the NASDAQ 100 is making a series of lower highs, may continue to do that. And there's nuances to reading these, which we can get into more at a later time. But then the NASDAQ comp, which is all stocks in the NASDAQ, you can see that's even more well-defined as being in a deteriorating uptrending condition. And that doesn't mean that the uptrend can't continue, but it does mean that it continues to narrow. You can see this very thing happening back in 2021. And so we watch these very closely, and other breadth indicators too. And the only other thing I would say that was really important to what Ramon said, he talked about how difficult that original, when the accumulation structure started back at the selling climax, and that it was a tricky period. Well, this is also true for distribution. At the highs, June, July of this year, you have this climactic surge and then a sharp break. And I think that momentum traders that are trading these Mag 7 stocks, Ramon, are going to find that it's going to be very, very difficult to trade these stocks going forward, because the market for these are very much range bound. So you're going to get a lot of volatility up and down in a tight, narrow range. And this is the kind of thing that happens as you change the character of a trend from trending to trading.
Okay. Well, we usually also talk about the cause and effect.
All right, you heard that, right? It's changing the behavior from a trend to a trading type of environment. So we could be entering that very shortly. Let me skip ahead because I don't want to get into that stuff here, because they're going to go into point and figure charting, which I'll get back to you later. I kind of gave you a sneak preview of point and figure yesterday by counting up how Zim, the projected price of Zim is going to be, that shipping stock, which, if we're going to have a strike that lasts pretty long, Zim could have a good catalyst there. But, I'll revisit that some other time. So let me skip ahead in this video to about 27.
This is a very Wyckofian term, and
okay, about here.
Case, I would imagine it's going to pull the Magnificent Seven stocks up with it. They just may not be as dynamically performing as they have been in the past. So, and we'll look at that in a minute.
All right.
Good question.
Let's continue now. Let's talk about the S&P. Same chart in terms of the duration. We have 21, 22 reaction, 23 and 24 uptrend. And now looking, Bruce, at this structure, I mean, look how much higher this higher low is there is more spacing. There's more spacing between these two lows right here. We are also overcoming the previous high of the buying climax stop in action, and it looks way, way more aggressively stronger. And again, I would be thinking that if we are going to have some kind of distributional structure, we need to see more aggression to the downside, not just the one that would undercut the previous intermediate low, but actually that would break a more meaningful structure. For instance, this now is the most important low, most recent important low that needs to be broken. Could we do that? And could we recover, maybe consolidate here without any lift and then go down like we did in 2008? That could be the structural development for the distribution if you're waiting for the distribution. But for now, you have to treat the market for what it is. And for now, it's higher highs, higher lows. So therefore, we're still in the uptrend until we're not. And by the way, looking at the 50 stocks above the 50 day.
So you see there, we have to just follow the charts for now. We can't guess or assume. We can hypothesize scenarios, right? But for now, with the data presented, we're still going to go up. Now, they were talking about the 50 moving average stuff previously, and he's going over it again right now with this bottom chart. You see the bottom chart with the red squiggly going up and down, kind of like snaking. I'm going to go over that after he presents this.
Moving average. When we are looking at this type of the environment, usually that is indicative of the trend or trending environment. And right now we're there, but we could also assume that we're in some kind of trading range that could see potential price coming back, maybe hitting the moving average, finding some kind of institutional value, and implementing this seasonal low volatility pattern into the November election. Bruce?
Yeah, beautiful. The only thing I would add is that note the difference here between the S&P, what we just looked at with the NASDAQ 100, is that the S&P is out of its defined uptrend channel for the bull market, where the NASDAQ 100 was actually flirting with the demand line, where so the S&P 500 is up making new highs. Think back to our heat map and how the heat map was showing all of those smaller parts of the S&P in green, and you can just see that in mass these stocks are tending to lift up the S&P 500 in a very broad way, and that bottom indicator, stocks above their 50-day moving average on the New York Stock Exchange, is at 75%. Means 75% of stocks are above their 50-day moving average. And I think that defines the characteristics of good breadth.
Mm-hmm. Dennis is asking, could it be upslope in trading range for the S&P? Yeah, I like this idea. I like this a lot. I mean, this, if we are turning around and we're coming back, this would be an upslope in trading range, potentially, obviously, and that still would be in line with an idea that we could undercut this low right here. And actually, that would be probably a more preferable scenario. And let me explain you why I think this way. I mean, all of this right here is an accumulation. They've been buying the stocks here. This is such an aggressive uptrend. Aggressive uptrends usually, unless it's a hypodermic, very speculative price action, do not end in the TP formation type of distribution, where there is a speculation on the way up and urgent selling on the way down. They usually tend to go into a trading range. Think about 2007, 2008, think about 2018, 19, COVID, and so on and so forth, right? So we have time for institutions to offload their positions that are huge, and it requires time to do so. But what also CO, heuristic that we use for smart institutions would do, is to catch all of the short covering, all of the shorts after this increased volatility on the upside, and also get the weak hands buyers buying into the highs, sell into this high, that would produce the move to the downside. Shorts are going to start originating their new positions. The longs, the weak hands longs would give up. And when that liquidity is going to increase, the CO would pick it up here again in some kind of oversold condition. That is a very regular practice by the CO, and it's not intentional. A lot of students would say like, oh, the CO is just chasing me. I put the stop loss, above or below the structure. I usually ask, how many shares did you have? Oh, I only had the 100 shares. Believe me, they don't want you, and they don't want your 100 shares. They want, big whales that would have like millions of shares. That's what they want, because they need liquidity. So they could create liquidity on both sides of the trading range, here and then here. And these are usually the places where they're going to operate. And everything in between is just, weaker hands are giving up their positions. So there are quite a few variations on how this structure could unfold.
You hear that? Liquidity. Everything is about liquidity. Where is liquidity? And the other thing they mentioned was that it's not TP formation. You're not going to have up, down, right? Or down, up, like an inverse V, right? You go V, you go up the other way. Everything has a structure. When people that are big institutions, right? That's what he called the CO, the composite operator. This is why coffee and terminology. So the institution is the composite operator. These guys, they have to sell and buy tons of shares. They just can't dump it or buy it quickly. It's like the crypto market. You see, they have like rug pulls like crazy. They got this stuff, or you do penny stocks where everything is so thin. The liquidity is so thin that's easy to pump the prices, crash the prices, stuff like that. When you're doing real big trading on the index level or in big caps, large caps, everything has to be done with a plan. If I'm planning to sell a lot of shares or I'm planning to buy a lot of shares, I am going to take my time because I don't want to affect the price. And so that's why you can see the pattern. So you have the luxury to see the pattern ahead of time, a Wyckoff structure, and you'll know they're going to buy, they're going to sell, they're ready to dump, they're ready to pump, just by analyzing the structure, because you're not going to be suddenly caught off guard. You can take the Wyckoff method and you can predict things. So this is what we're going to try to do. We're going to try to make it so that you can practice this. Hopefully I can do that later on. But for right now in October, I'm just going to introduce concepts, and I'm just going to keep reintroducing concepts. So repeat. And once you get comfortable with the concepts, we're going to apply the concepts. So just having the knowledge is one thing. Applying the knowledge is really the next step that we have to do. Okay.
But the principles, the concepts behind the COs buying and selling is going to remain the same. Bruce, what about the P&F counts here for S&P?
Yeah, this is so amazing to me because as we just saw with the Mag 7 style stocks in the NASDAQ 100, is that we have a really good, well-defined accumulation count that has just effectively been fulfilled, and the index rejected that level and turned down pretty hard. Look at the S&P in contrast. Roman, we have here, we had two segmented counts, and at the time that we posted, especially that top chart on the right, when I originally did that chart, and I put it in power charting episodes, and we certainly talked about it here a lot, is people thought I was certifiable. And of course I am, but not for those reasons. And so this count, look at where it goes. And we said it at the time, and the count line was what at 37.75. We said we have a count that goes 62.75, 65.50, and so I leave that count up. That's June of 23 when I posted that structure and counted it. And and then the chart below is a slightly different construction, 50-point scale. The top chart is 25. That's the main difference, 3-box reversal. And you can see the count is slightly different, 6350, 6700, still in the same ballpark. And so currently we're in the neighborhood of 57, 50-ish in that zone. And so we have still got room to go. And arguably, as Randall pointed out, we could even stretch this count out some from where we took it. I have a tendency always to err towards being conservative in counting, and I like to count segments. But this is the what I consider to be the most important accumulation count. But we get up.
So that's the tic-tac-toe chart on the right there. I mean, I kind of went over it a little bit. So let me go over what I did for Zim. So this was my my price target for Zim here. There we go. So about like 35 to 42. Actually, let me go back. Yeah, I think you can see a lot of these things. Oh man, I recorded that like stupid little thing. Like, all right, let me see. All right, back here. No, you should see some CBS receipts. But anyway, so I did my little counting, and I'm not gonna go over how you do the tic-tac-toes. All right, this is what they call point and figure chart. You can learn it on your own. Let me give you the link. You can go to YouTube. All right. You can go to Stock Charts TV, and you can search point and figure in their channel. All right, here's the link again. Let me give it to you guys. Here, there you go. Have fun. You can go to that Stock Charts TV and look up point and figure. Okay. So you look up point and figure in Stock Charts TV. That'll be it. You can look at you should look for Bruce Fraser and look at all his videos about how to construct these things yourself. But in any case, I did this one for you. You see that accumulation range here? You see that boxy area? That's where the reaccumulation is, and we just broke out of it. Now, we recently broke out because of Jerome Powell lowering the interest rates and China doing stimulus. Now, we got this third catalyst, the strike on the East Coast. So this company does West Coast shipping. If a lot of containers are being rerouted to West Coast ports, they'll probably get contracts with Zim to deliver it to the port of Los Angeles, port of Oakland, all these places. And in that case, you got 3 catalysts. Now, I mean, the extra one for the East Coast is probably not going to last, but hey, I'll take it. Because once we got out of this box here, potentially we could get to 35 to 42 in terms of price. And I started buying around 24. If it pulls back to 22, I'll buy some more. But I'm assuming it's not going to drop below 22. Okay. And then once we're done here, we'll finally break out and get up to there, assuming the US economy doesn't falter, right? Assuming. Then by next year, I should easily clear to 35, 42. And who knows? This stock used to be a $90 stock. Maybe I'll go back there one day next year. if we get a lot of bullish news. So just in case, you have a longer target to go. But for now, I'm going to say 35, 42. So if you bought at 24 and 22, hey, that's a 50% gain right there to a 75% gain. Anyway, let's continue on. I don't know if there's much
That
more. I'm going
level,
to do that.
say call it 6,350 to 6,700, and we get more count potential for upside. Richard E. Wyckoff used to say, when you hit your count objectives on indexes and stocks, it's stop, look, and listen. Pay attention. It's not automatically a reason to sell stock and or sell your position. And that's exactly how we approach it. So, and I think it's amazing, Ramon, just to make this point again, NASDAQ 100 has fulfilled its accumulation count. S&P 500 has still got meaningful higher count to go.
Mm-hmm. All right, let's move on. So this is the daily chart. Oh, I'm sorry. This is the daily chart, but this is a fascinating chart that Bruce always talks about to us. Bruce has developed, this quarter end effect, and we've been tracking it here with Bruce's help since probably almost day one. So Bruce.
So I mentioned this before. Everything in the financial world works on quarters. Everything works on a quarter, monthly basis. You got months, you got quarters, and you have the fiscal year. Okay. So every time you see the end of the quarter, look at the price of a chart. Look at where a stock is moving. They usually have some interesting interactions around the end and beginning of a new quarter, the end of the old quarter. Okay.
Please walk us through your ideas here. And what does it mean that we are close to the end of the quarter now? What could we potentially expect?
Yeah, so if there's any one thing that you take away from our time here today, I would suggest it's this. And that is that let's all be clear that the institutions are a hurting animal. They are hurting in the way that they make decisions. There's a few institutional types that are exceptional, as is always the case, and that we call them the composite operators or the composite man. But for the most part, these institutions all just travel together in the same stock, same ideas, same themes, same trends. And so I've taken these back in my 30 plus years ago. I went back and studied the quarter end effect going back into the mid 1800s. And so I'm obsessed with it. Ramon and I talk about it all the time. And so note that the basic rule is look at how these lines, the light blue and the light green, tend to nest around the ends of quarters. And the highs nest near the ends of quarters, the lows nest near the ends of quarters. And you can see that there's acceleration of trend into the end of the quarter. And so this is a very, very important concept. And it's an edge, an advantage that we have over these institutions, is that we do not have to think like them. And so the basic rule of thumb is plus or minus 3 weeks to the end of the quarter is where we will tend to see a trend up or down, nesting, its high or low nesting inside of that 4 to 6 week window. And so, and here's Ramon highlighting those effects. And this is incredibly powerful as a tactical tool. And let me show you just an example. And that is, let's look at October of 2022. And you can see that very sharp decline into that October end of the third quarter low. The lowest low occurred a couple of weeks later. but look at the trend accelerate down into a downtrending channel line, into an oversold condition, and was developing internal divergences at that time, which means the CO types were buying stocks in what they considered to be the value zone, slightly above the June lows of that year. So that June lows came 2 weeks prior to the end of the quarter. So we can see here that the institutions were basically dumping stock into the end of the quarter, and only the institutions have the ability to be able to create this kind of buying and selling pressure. Now, we can go back, look at what happened. This is even more important than that October low. Look at the December low in 2022 into the end of the year. So that low right there was a higher low, but look at the sell-off that occurred, and a number of stocks, important stocks that had huge bull runs, went down and equaled their October lows at that time. And we would be looking for stocks that have the right accumulation characteristics at the end of that period. And we talked about them here. And we talked about that being an end of the year quarter end low effect. And then look at what happened thereafter. That was, to me, end of the year 22 was the best buying opportunity of the bull market. And it came right on the support line of the accumulation structure. Just beautiful. And Ramon, the only other thing I can really think to add here, look at the July peak, which occurred 2 weeks after the end of the second quarter. And that was the high internally for the Mag 7 style stocks. That was the internal peak there right in July of this year. And you can see there that had the momentum to carry for a couple more weeks into the new quarter. And then you just had a very, very important automatic reaction decline occur after that on very heavy volume. So the end of the quarter brought supply in a very big way at the beginning of the third quarter. And now look at what we have. We have a market that has rallied and rallied up into the end of September, and it is rallied to a new high at the end of the quarter. And I wonder if that doesn't mean that we're going to get some kind of a correction, which Ramon actually just talked about earlier in a prior slide. And so you could see that we have, I think, the potential to have some kind of a reaction in here, supply present to come in at least for a little while. And there's some seasonality reasons for that also, which we'll talk about in a few minutes. So Ramon, those would be the key points I would make with the time that we have.
Well, let me ask you the question, and I think I know the answer to this because you've talked about this so many times in this class. And one of the value for me in this research is to understand what kind of character for the quarter we're going to have. I mean, it's something very elusive, this whole word character of the price movement. That's what our students usually have like the biggest problem with. So when you talk to us about how the quarter could potentially unfold, you said that you have the quarters where you have like a pure move, and obviously, again, this is just a little bit displaced, right? So we could have plus 2 to 3
Well, kind of not really. I mean, that was a beautiful.
Yeah, right here at the top, right?
Well, and look at the low we had right a week or two into the new quarter, and then a rally. So your point is really good, Ramon. Look at the characteristic of that third quarter or second quarter rally in the S&P 500. That was a pure uptrending move for the quarter. So that's the character of the quarter, which is your point.
Yeah, and I'm just kind of like thinking from institutional point of view, because both of you and I, we've been in the institutional world, we've been hedge fund managers, so we understand how important the quarter is for an institutional investor. And looking at this, look, this quarter is in advance. This quarter is in advance. This quarter is in advance. Latest quarter is what? It's a trading range. Even though we have like those ups and downs, but on average, what did the price do? the price kind of, stayed somewhat flat. So you could go and you could uh, have multiple moves in the quarter, but let's say like here, I would say nothing special. This is probably more of the advance. This is more about the decline. This is more about the decline. This is more about the decline. This is more about the advance. So you could see the behavior, the character of the institutional either buying or selling, and you only need to think about how to time the tops and the bottoms of the quarterly highs and the lows using our tape reading Wyckoff structural techniques. And I mean, that could be such a powerful technique and powerful tool for us to execute
Well,
our trading. Mhm.
and we talked about this in WMD as we went into the third quarter. We talked about the fierce uptrend into the end of the second quarter, and then once we got the sharp break, we had, it was quite clear to us that the third quarter would be a range bound quarter that would be largely range bound. And in fact, we even alluded to that when it was pushing up into the highs in early July, is that this was probably an overbought extension and end of the uptrend. Is that range bound condition in the third quarter? You look at the NASDAQ comp, NASDAQ 100, and they have not made a new high. And so very much they are very range bound. The S&P 500 has made a slight upthrust here,
Interesting.
but still has
Okay.
been largely range bound for the quarter.
So I wonder what might happen next, Bruce. I mean, for the next quarter. I mean, seasonally, we're expecting some kind of low, and then after the low, we're expecting, some kind of rally into the end of the year. So maybe the structure of the quarter could be, and I'm not saying exactly this way, but maybe akin to like this, where first it goes down and then it goes up. And then obviously the character could be, slightly different. This looks kind of the same, or maybe even something like this. I wouldn't be thinking that it's going to be like an extreme decline like this, probably of slightly lesser degree between this and this, if we're going to have any. We just need to test one more time this low. Would you be thinking that the fourth quarter could have that type of structure?
Absolutely. As a matter of fact, we're going to cheat a little bit in a few minutes when we look at seasonality to see if we can't have it help us with this, the eternal question of what could the fourth quarter look like.
Well, let's just go right into it, and we'll start with the decennial pattern. So it's kind of interesting, Bruce, how you have the accumulation schematic here at the top, and then you have the decennial pattern. We're on year 4, and
So this is an interesting chart here. If you believe in seasonality and repetition, you know, the election cycle every 4 years in the United States. And interestingly enough, Bitcoin, it has its halving cycle and it lands on the 4-year election cycle. So the phases match. So I don't know if it was done by design, but you see every time Bitcoin has a big rally, it aligns with the election cycle. So very auspicious there. So what they're going to go over here is that usually in the decade, the 10-year cycle, if we believe in that, every 5th year, so the years ending in 5, so next year is 2025, we're going to have a big rally. Now, this is not always the case, right? 2005 wasn't a good year. I don't think 2015 was a good year either. So it's not always true. But, we have had an interesting past 5 years due to COVID. So, and a lot of people are still in bonds, specifically T-bills that are paying 5%. And only recently has it dropped down to about 4.5%. And I'm sure when the Fed cuts more and more, it'll be like 4, 3.5%. That kind of return doesn't look that attractive. And people want more risk. As I said, people are greedy. It's all about psychology. Even though you get no risk from buying bonds and getting that coupon, the problem is that you need to outperform. And people are greedy by nature. So they're going to be willing to take a risk with more of their funds and put it into stocks. So I assume that next year, if things don't turn for the worst, it could be a very good year ending in 5.
See a big resemblance between the schematic and the actual decennial pattern of year 4. Would you care to explain what's going on?
Oh my God, it gives me goosebumps. It's looking at our schematic, our Wyckoff schematic of the accumulation structure, and you know what this goes to, Ramon? It goes to our campaign workshop that we're going to do at the end of the year, because we look for these characteristics of large accumulation structures producing large uptrends, and this is going to be a big part of the workshop. But so here you can see now, just for explanation, very briefly, and I'm sorry to be rushed because we don't have a lot of time, but then thank you to SeasonX, our good friends who do give us access to these wonderful seasonality tools. So you can see here that from the 0 year, and so what we've done is, and SeasonX did this study, 1897 to 2020. They took every decade, and then they basically just summed up the index returns every month, every year, and then correlated them year by year by year to get a 10-year decennial pattern. I've been looking at this pattern for, nearly 40 years, and it's eerie how well it can work. I mean, it either works really well or it doesn't work at all. It's my experience. And so you can see here that the seasonality starting in the 0 year and going over to the 4th year has the resemblance of accumulation. I put the accumulation schematic up here just so you could visualize the relationships, and I actually put in the labeling. And so here we are. Look at where we are. We've had a really good run to low in the 2nd year of the decade. We've had a really good run in the first part of the bull market that went into the 4th year, and then a largely range-bound condition in the 4th year, which in this case, the 4th year in the 2020s is an election year. So we'll talk more about that in a minute. But notice how that correlates well with our phase D schematic of a backup and a last point of support, and which are Wyckoff characteristics, which come after a really good sign of strength and getting above resistance and then consolidating there. And look at what often happens in the 5th year of the decade. The 5th year of the decade can be just glorious. And it is the just unfolding of a major, major uptrend. And this is after you get out of the accumulation. And we just looked at how so many of the S&P 500 stocks are just starting to get some love from the institutions because they've been neglected throughout this whole period as the Mag 7 style stocks have been getting all of the the institutional attention. And so look at how we can get literally an uptrend that can go from the 5th year all the way into the 7th year. And so I could talk about this chart forever and ever, but I'll just make the point here that we are certainly open to the idea of this. We have higher point figure count objectives, as long as we don't get the classic characteristics of distribution forming And we always are in the moment with our analysis. We're not wedded to any point of view, but we're definitely scenario building all the time. And nobody does scenario building better than Ramon. And but here is a look at a possible fifth year and what could be the potential for being able to create returns in the fifth year. And heaven knows why that would happen. In my world, reasons are optional.
Well, yes, and of course we could speculate here. I mean, I remember this resembles 2016, 2017, and then like you put one thing to another and realize that certain changes could bring that type of expansion. So we'll have to see if this is going to happen or not. But
so far our accumulation structure is supporting the idea of this so far. So that is a nice feature, is that you do have a white coffee in case for this. And again, we are always open to information that could tell us that that something different is happening.
Bruce, and I'm thinking that, okay, maybe we had that buying climax and now we are somewhere here. And we keep talking about, there is a possibility of the reaction that is going to test the previous leg down. Okay, going into the November 5th election. So we're pretty close to that. And then seasonally into the end of the year, we might have some kind of rally, which will translate into 2025 potential rally. I wouldn't necessarily say that the fifth year is always good. I mean, like just going back into the history, 2015, right?
Exactly.
2005. Yes. They might have some kind of upward momentum, but not necessarily like as strong as 1995. 1995 comes to mind right away. And actually, the decennial pattern like this, in a lot of cases, take a lot of weight from 1995 move. And that's basically when I look at this, I'm thinking Bruce instantly 1995. But at the same time, like it's just uncanny how even here we're seeing reaction, the low, and then into the end of the year, a possible seasonal rally that is also being supported by a more granular work by the same Season X. And Bruce, like this low here in October, and it could be later into the, slightly later into the election in November. And then we see the rally unfolding into the end of the year.
All right, I'll stop here for now. I think you have the idea of what might happen into October and then later on after the elections. So let's go to our lesson. So we got 30 minutes. I'm going to do 30 minutes left. Let's see if I can get through this. I'm going to remind you to go look up the point and figure charting here. You can go Stock Charts TV. All right. You go Stock Charts TV at Stock Charts TV and go search point and figure. Look at Bruce Fraser. So any video with Bruce Fraser, watch the videos. He does the best charting with point and figure and using that technique to give projections in price. So then you'll have an idea of where a stock may go. So you can use that to do your risk reward analysis. So really just look for this white dude right here. And in the description, look up Bruce Fraser. I think, you can, or the title, Bruce Fraser. F-A-R-A-S-E-R. F-R-A-S-E-R. Okay. Yeah, I can't highly recommend him enough. Continue on to our lesson. Let's see if we got our lesson here. Here, let me read you this article. So Stock Charts has pretty nice articles that go way in depth, more in depth than Investopedia. So they have what they call a chart school. So I don't know. You can read all these articles yourself. I'm just going to mention these important ones as we go through October. Anything I feel like you guys really need to know. So one of the concepts that was mentioned in that lecture was the 50 MA breath indicator. Okay, what did he mean by that? So when we went over the chart today, we talked about SMAs, right? Simple moving averages. I used 18 and 40. Now, typically, people use 50 to 100 moving averages. So we can look at the health of the whole index. Let's say S&P 500. There's 500 stocks. 500 stocks. Which of those 500 have charts, have prices that are above their moving average? And specifically the 50-day moving average, right? So that was what was used in the lecture. So if they're above that 50-day moving average, we could assume that they're doing well. Now, that's not really true because you could have a downtrend and then it's just recently trying to make an uptrend and it's above its 50-day moving average. But let's assume that this is a good way to find out how healthy the stock market really is. Okay. So this is a secondary indicator. This is another way of looking at the stock market using underlying information behind the scenes, okay, using indicators. So this is what we call the percent above moving average, a breadth oscillator that measures the percent of stocks above a specific moving average. Okay, let me see if you guys. Yeah, I think this is big enough. Let me zoom in some more. Percentage of stocks above a moving average, internal market strength or weakness. When an index continues to move higher, it will be helpful to understand if there's internal strength behind that movement. The percentage of stocks trading above a specific moving average is a market breadth indicator that can measure the internal strength or weakness in an underlying index. For short to medium term time frames, it's helpful to look at the percentage of stocks trading above the 50-day moving average. For medium to long term time frames, it's best to look at the percentage of stocks trading above a 150-day and 200-day moving averages. You can get trading signals from crosses above below 50% overbought oversold levels and bullish bearish divergences. The indicator is available for the Dow, Nasdaq 100, NYSE, blah 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 blah. So stock charts, I think the free version you can easily chart this stuff. So you don't need to pay a subscription for stock charts to get this indicator. You can go to stockcharts.com. You can mess around with it right away. In any case, let's go down here. What does the percentage of stocks above a moving average tell you? This indicator measures the degree of participation. Breadth is strong when the majority of stocks in an index are trading above a specific moving average. Conversely, breadth is weak when the minority of stocks are trading above a specific moving average. Okay, this is what is meant by breadth. Right now in the S&P 500, I told you that the XLK, the technology sector in the S&P 500, made about 31% of the total index. Okay, so this is huge. Now, let me get a graphic for you guys. This will be this graphic will make it more clear. Yeah. Now you see this graphic? Okay. So infotech technology is 32%, right? So I said about 31. So it's about 32 on this chart. Now, over periods of time, we have different sectors leading the S&P 500. So back in the 80s, oil and gas was a big component of the S&P 500. In the 2000s, the tech bubble, the dot-com bubble, it was 33%, right? And then now we had financial, the banks, the big banks before the 2007, 2008 crash was 22%. Now we're back here. Infotech is 32%. So we're right back where we were in the dot-com era, because this is driven now by AI, 5G, COVID-19, all that good stuff. Infotech is now the big kahuna, the big kahuna right here. And of the 32%, 7 of those stocks, well, not all 7 are in Infotech, but let's just say the Magnificent 7, most of them are Infotech, are driving the stock market right now. So that means we have pretty weak breadth, okay? So that's what they mean by breadth, breadth, not your breath in your mouth, breadth, okay? Meaning how broad the market participation is. So hopefully that makes sense. Let me continue reading the article. There are at least 3 ways to use these indicators. First, chartists can obtain a general bias with the overall levels. A bullish bias is present when the indicator is above 50%. This means more than half the stocks in the index are above a particular moving average. A bearish bias is present when below 50%. Second, chartists can look for overbought and oversold levels. These indicators are oscillators that fluctuate between 0 and 100. With a defined range, chartists can look for overbought levels near the top of the range and oversold levels near the bottom of the range. Third, bullish and bearish divergences can foreshadow a trend change. A bullish divergence occurs when the underlying index moves to a new low and the indicator remains above its prior low. Okay. Conversely, a bearish divergence forms when the underlying index records a higher high and the indicator remains below its prior high. Okay, what does all that mean? Let's look at it, visualize it. I think the divergence part is the most important part for you to understand today. Okay. You see this one? You see this chart? So this is a NASDAQ, and it's using the 50, right? So how much of the NASDAQ composite is above its 50 moving average? Now here, it's made a higher low, but the index itself made a lower low. So that's a divergence. So even though the index is dropping, you see the signal here says, hey, wait a minute. Internally, there's improving breadth. So that means I should buy here. I should buy this low here because it's probably going to go higher. And yep, it went higher. Now, guess what? Let's see what happens here. The index made a higher high, but the indicator, the number of stocks that are in the NASDAQ composite that's above its 50 moving day average is lower low. So now we went sideways. See here? We're going sideways. So it's not perfect. I mean, this doesn't mean like, oh shit, it's gonna crash, right? I mean, and this thing doesn't mean it's really gonna rally. I mean, it doesn't work like that all the time. But it kind of gives you an indication that, hey, internally there's something happening that's different from what you see in the price. Okay, so that's what we call a secondary indicator. I gave you a ton of examples last time, so you can review it in my last video from last night, and you can see what I mean by secondary indicators. So this is just one example. So there's so many examples of secondary indicators, and I could keep going on and on and on and talk about each one. So, but I'm just going to try to give you the most important ones that I think people should know in general. Now, let's move on to something more advanced. Now, there was a reason I was talking about exponential moving averages, because this indicator uses simple moving averages, And that's why I gave you that example of exponential. I tried to give a definition of it. Hopefully you kind of understood what that meant, because we're going to use a different one here that's related to this, and it's called the Golden Cross Silver Cross. Let's go to this article here for you guys. Let's read this one. New industry group, Golden Cross indices and Silver Cross indices. So in stock charts, they provide these nice, very nice indicators for you called Silver Cross, Golden Cross. And not only so, the other one is only does by industry group. Right? I mean not industry, index group, right? So they do the S&P 500, they do the Dow Jones, they do the Nasdaq Composite, they do the Nasdaq 100, blah 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 blah, Russell 2000, etc. Here we use the silver and golden cross. We can look at each individual industry group or sector. All right. So we can do the same thing, but this indicator uses EMAs. They don't use the SMAs, but similar idea. Very similar idea, but it's more sophisticated because not only do they use EMAs, they use the cross, okay, of those EMAs. So when the 50-day EMA goes above the 200-day EMA, or the 50-day goes below the 200-day EMA, it creates signals, okay? And this is where this thing comes in play. We have begun collecting Silver Cross Index and Golden Cross Index data for 4 new industry groups. Let me zoom in, make sure you guys can see it. And stockcharts.com back calculated data for 2 years. So they added biotechnology, regional banking, retail, and semiconductors. Now, these guys, they also have a lot of other industry groups. So you guys can look it up. Go to stockcharts.com, look up Silver Cross, Golden Cross, and you can find these indicators for yourself. So first, let's cover what the Golden Silver Cross indexes are. The Golden Cross Index shows the percentage of stocks on long-term trend model buy signals. 50 EMA above the 200 EMA. The opposite of a golden cross is a death cross. The Silver Cross Index shows the percentage of stocks on an intermediate trend model buy signal is 20 EMA over 50 EMA. The opposite of a silver cross is a dark cross. Let's take a look at our new industry group, Golden Silver Cross indices. Since mid-January, we have seen the relative strength line falling. However, notice what was going on under the hood. Participation was increasing and Silver Cross Index was rising. Relative strength was misleading. During this same period, IBB has been in a rising price trend. IBB being the biotechnology group. See? So this is the price of the biotechnology ETF. Okay, so this is a pretty risky sector in healthcare. It's a sub industry of healthcare. You can see here the Silver Cross Index. So this thing is a secondary indicator. Same thing here. So you see this green line here? They highlighted this green dashed line. They kind of did between, I guess, March, June of 2022. Like, let me see if you guys can see my cursors. Yeah, I don't know. Hopefully you can see my cursors. Yeah, you can see my cursor when I have this fat cursor here. So you see that made a double bottom here, and then this was an uptrend. So under the hood, that's what they were saying. It was starting to bottom out and make a new uptrend. So that's what it kind of has been doing since that point. So that's what they call a divergence. You remember what I did last time? Divergence. You see? It's making a higher low when the price is making a lower low or equal low. All right? You see that? That's divergence. So the price here was about the same or lower, right? Going down, while the indicator was indicating that things underneath the secondary indication was going up. So we're seeing something different. Now let's go back here. Regional banks have been seeing participation shooting skyward. The relative strength line is in agreement with participation, which suggests overall strength. Notice the Silver Cross Index moving vertically higher. This is the industry group to pay attention. So nothing interesting here. I mean, the secondary indicator confirms what we see in the price. So nothing interesting here. Anything else? This one probably nothing interesting as well. Silver Cross Index and Golden Cross Index are rising nicely in XRT. Participation is robust. Notice that when the Silver Cross Index is turned up, the relative strength has not begun to rise much. Participation began to improve even before the Silver Cross Index could have gotten us to into the rally sooner. So, yeah, it's just confirming things here. Yeah, overall, you can look at it for multiple industries, and I think semiconductor is the most interesting one. We have to follow semiconductors. It really is the leading subsector of AI. So the hardware kind of leads where the rest of the software group goes. So hardware leads first, then we see software, and then we got start seeing the other downstream effects on it. So will AI improve productivity for the economy? Well, it remains to be seen. The SMH chart is a bit disjointed. SMH being the ETF for semiconductor. That's one of the ETFs. The other one is SOXX. Okay, mainly because there are fewer members in this industry group ETF. We know this group has shown amazing leadership, and looking at the participation numbers, it's still going strong. Notice we just got a long-term trend model golden cross buy signal on SMH as the 50-day EMA crossed above the 200-day EMA. This is one reason we see the vertical rise in the golden cross index. If the group itself is getting a golden cross, the stocks within are likely to seeing the same thing. Currently, all of them have price above their 2050 EMAs, 50-day EMAs. And that has pushed the Silver Cross Index to 100% as well. 100% is very strong. All right. You see this thing keeps hitting. That's why this was so when this article was written, we were just starting in 2023 to make a turnaround, right? This was at the infancy of that bubble. And the bubble reaches high pitch fever at the beginning of this year in 2024. So the inception of it was already seen right here. You see this huge participation during the bottoming out in 2022. What this tells us is that we should see a rally continuation. As soon as the participation numbers begin to crack, we will be warned. Okay, so I think that gives a good summary of secondary indicators for this week. I've done a lot of work on here. It's almost the end of the second hour, and I think I'm going to remind you guys to go do your homework. Your homework is to read this PDF, Wyckoff Trading Range. Okay, guys? It shouldn't be hard to do this. It's just 12 pages. You can read it. You can learn it. No problem. Do your homework. Here's just a PDF. Come on, guys. It shouldn't be hard. Read it. Anatomy of a Trading Range by Jim Forte. So that does the Wyckoff model here. So it's very, very basic. You guys can read it yourself. I think, to close things, I'm gonna talk about I'm gonna go over another chart before I leave. I think I had a question by Momo about like how do I know where the resistance and support are, right? And I suppose we should spend some time one day to go over practicing it. You know, a lot of practice. So let me look at this chart here. So this is SMCI. Okay. And I use this example. So this is a daily chart here. I use this example as a distribution. So during the February to July was the start of that distribution from phase A, phase B, phase C, phase D of Wyckoff. I mean, phase D is what we're in right now. I don't know if we've entered phase E yet. We might soon enough. And the thing Momo asked me was, how do you know where the support and resistance are? So let me move up one. Let's go look up at the weekly. When you look at the weekly chart, you can see right away. You see this big red candle? I would say that sets some range, right? That's going to set a range. This is a range right here. So maybe that's resistance or support somewhere down the line. Now, here's another one. You see this gap here? There's a gap. I'll use the open, and I'll use the close of this. That's my trading range here too. It's support resistance. It could be a trading range. It could be some kind of zone that there's no go. I mean, what's interesting is when you set this stuff, it clearly defines an area. You see this? Once they had that big red candle for the week, none of the trading range action happened above 50% of this red candle. So it stayed below. Stayed below. It was building some energy here. So I think if we zoomed in to the daily, you know, it was kind of slowly climbing. And then for the last few areas here, you see the bars making higher lows now. So unlike here where we kept going back to the below, below this purple line, now we're starting something. So this was already happening before this news event. I'm guessing this news event had something to do with Nvidia. Usually SMCI follows Nvidia, so but you can kind of tell there was something going on. You can see the footprints here. Somebody was buying and it pushed it up to the upper purple line here that I set. So you see what I did, right? I didn't do anything special. I just decided when I looked at the weekly chart, I look for the biggest candles. Look for the biggest candles. I'm going to look at this candle and I say this is the bad boy that I have to use. Then I go back down to the daily chart and I analyze it and I see, oh, hey, look, somebody's buying. So maybe I should buy more. Now, after that, we have the news event, boom, 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 all the way up here. Now, this is the next big candle, right? So on the weekly chart, I don't see that. Weekly chart, I just see this gap. I don't see that big red candle. But now I go back down to the daily. I now see this candle here. So this thing is pretty significant as well. But for now, this gap, I'm going to use as tentatively a range. Because what you see when you go look at the weekly is that you see that most of these candles, the wick, the shadow of the candle penetrates this area, but the bodies always stay below it. So that's interesting, right? That's really interesting. That kind of shows like there's some weakness. You'd never see it try to get back up because once we had this high in March 2024 for this stock, everything was just like it just slid back down, and then you had this huge red candle, weekly red candle below the range, and it's trying to fight to get back up here. That's no good. So you could say it's distribution. If we go look at the daily, it's more clear. It's way clear that this is distribution. So I went over this chart in the last time, and I said, like, you could look at this schematic and you could pretty much figure out that this was a distribution pattern and it was going to go lower. And right now we're in probably phase D going into phase E, and the last phase I assume is going to hit back at 25. We're going to complete the pattern and go back to around 25 if October is really bad. So keep an eye on this stock. I would buy it if it hits 25 for sure. I'm going to buy it again. I mean, I bought it back around here when it was like 11 or something. I didn't buy it real cheap. I mean, I wish I did, but that would have been back in COVID, So there's so many stocks, you just can't keep track of all of them. So, all right, we hit the 2-hour mark. Thanks for listening, guys. You can hit the replay and hit the Cash Apps, like and subscribe on the Urban Landlord. I'm going to put up all the Cash Apps and we can end it with some music here. So yeah, hit the Cash Apps, guys. Hit the Cash Apps. And I don't know if I'll be here tomorrow. Like, I'll be pretty busy. But I'm trying to get it to be at least once a day for the weekdays. And if I miss some weekdays, I will make it up to you guys on the weekends. What's up, Gary? And you missed the whole show. You got to go back, replay it. I went over a lot of stuff. So, yep. Hopefully you guys can get something out of it, and I'll be going over to the 24-hour stream. I'm not sure what's going on over there. I mean, last I saw, we had Cosmic Fox, Melanie in the chat. I think this drama is not ending. I don't know if I'm going to have to be called to a meeting and we're going to have to vote people off the island. But hey, I don't want to get involved, really. You guys do what you do. All right. See you guys. Have a good trading day. Oh, women talk. Well, yeah, that's how it goes sometimes. But yeah, before I leave, maybe I should check how the futures are doing. I don't think that they look good. They definitely did not look good. Yeah, it looks weak. Looks weak on the overnight. We'll see what happens when they release data at 10 a.m. Eastern. We're gonna get the service PMI. Yeah, looks pretty weak so far. That is not good. We're right back where we started when we had that huge dump on Tuesday. So we'll see, guys. We'll see. I mean, I'm tentatively optimistic, but we are in Jewish New Year's. So anything could happen from here on out till Friday. So be prepared for that employment data. That's going to be 8:30 Eastern, Friday. Employment data. Big thing. All right. Have a good day.